Good morning, everyone. Hopefully, we're live. I see that some people may have missed the good morning reference. So it was an old British TV sitcom that was based in France, but they're all kind of undercover agents set in World War II. So there was this cop who is undercover, and he's always starting the day with saying good morning because he thinks that's how you pronounce it. So yeah, look it up. It's called London Calling. It was a very, very old TV show, but really funny. So yeah, it was quite popular when I was a kid. Like Stephen Stewart said, "Are we looking for the fallen Madonna with the big TP?" Yes, that is exactly what we're going to be looking at. Okay, let's have a look at where we are with copper, because that's what we're going to be trading here. I'm just going to bring up my Topstep X combine that I was doing, and then we're going to see what's technically going on, levels, what happened in Asia, and all of that good stuff. All right, so we could have some signs of an early trend change on some larger time frames. As you can see here, I've named my combine London Copper. So now, whenever I'm looking at it, I'm not going to mistake it for something else. I know that that is the one where I was doing my experiment for copper. Okay, so I'm just going to move that to the side. Let's start with like a massive time frame, weekly chart. Now, this big gap here, I'm not sure whether that was like data thing or whether that really was a gap because I wasn't actually watching copper at the time. But we have arrived to some areas of previous demands here, and we're seeing a reaction on the weekly chart. Let's have a look at the daily chart. Daily chart has some accumulation happening. So if you look at here, yesterday we were kind of battling through this area of supply, which is located at roughly around 410.11. And now we managed to push through that. So if I look at this accumulation as a range, if we come out of that and we pick up speed above 1566, that will signal a trend change. And then typically what happens then, they seek liquidity over the next, few days up to the next available supply, which is located all the way up at 423.65. We do have some big events today. We have FOMC, and then we have NFP on Friday as well. So I wouldn't be surprised if we're pretty quiet until all of those are out of the way. And I mean, FOMC is always a riot, so we'll see what happens. For now, I'm going to be a bit careful with positioning myself because I'm not seeing much momentum on the day time frame, but this is what's going on the very large time frame. There is a chance that this is that decision point where we need to pick up speed, break out of the range that we've been consolidating in for quite a few days now. And 4-hour chart, I mean, we are at the swing high of the range that I was talking about. We are seeing some sell-off because we did go up quite a bit overnight. That was a pretty good move. So if I go to the Asian session, this indicator is currently set to a Shanghai hours because I've noticed it like volume really picks up during Shanghai Exchange active hours. So that's where I'm anchoring my calculations for the Asian session, even though Tokyo starts, I think, about 90 minutes before then. But yeah, look at how it picked up. And it went up, and then we kind of consolidated a little bit ahead of London, and now we're selling off. So we could have gap rolls here for London. Top of the range, waiting for big events. Let's see what happens here, because we tried to go higher, failed, and now we might have the opportunity to run the short through VWAP if we get enough volume there. I don't want to be front running this because, like I said, for now it's pretty quiet. We've only had like the initial balance of 37 ticks, which is very, very low. And not good for any kind of failed auction. Even a neutral day would be a little bit pathetic to work within that range. So we do need some more initiation from somebody to tell us that this is what we're looking for. But let's put down some hypotheses. So hypo 1 would be that gap fill, or at least a partial gap fill. I'm not expecting like, huge moves. And I'll explain why I think it might be a partial rather than full. And then second hypo could be maybe longs to catch that break from a better area. But I'm not sure we're going to be getting that for London. So we'll see how the day continues, and that might be a setup for tomorrow, but I'm still going to put it in. So effectively catching, in this case, if it does happen during London, it will be an auction fade after a drop for a breakout. Now if I put my volume profile on here, you can see the average session range low around 4, 10, 42. So these like yellow dots on my chart. And if you look at the volume, there is a bit of a low volume node right there. So this is why I'm thinking we may not have a full sort of gap fill down to London value, which is down at 406.91. But this area would be pretty good to look for a bounce. So 410.52 all the way down to 409.55. If you were watching Market Talking with Dee yesterday, I had a level on ES that was also taking the single prints, and then I said we might pull all the way through that area, and guess what? That's exactly what happened. And it turned around, I think, within maybe a couple of handles from the top of the single prints. So if you flip that on the other side, this would be the same expectation. So we have the average session range at the top, at the beginning of the single prints, and then as you go through it, it's very likely that the price might go through it pretty quickly and then run into these thicker volume areas where we may see some slowdowns and stuff. But what's generally happened in the past is that they traverse through the single prints and pretty much to a couple of ticks they reverse it, if that's what's going to happen. So that's a very, very good level that matches the larger time frame picture too. Okay, so what could be the third setup? Third setup, obviously neutral day, but I don't like to do that when we have a very, very small range. That gets very painful. But I might say if we try go higher and then fail, there is an average daily high right above here, so that would be a neutral day short. Now, if you're somebody who's never done these sort of analyses before, pop questions into the chat. I'm happy to answer them. Why something's called a neutral day, partial gap fill, like anything that's unclear, just feel free to ask. Auction fade is kind of my setup that I've developed after years of seeing these setups happening that are not failed auctions, but they are fading the existing auction. So it's like, it's not a failed auction, so what do I call this? And I decided that the auction fade was a pretty good name. Yeah, so no setup for now in copper. I'm going to have a look at some other markets. YM in its own world. Maybe we should trade a YM today. Hindsight Capital reporting for duty. Okay, daily chart. We're about to arrive. This is Dow, right? So we're about to arrive into an area of a previous supply. So what is a supply? It's basically the area where we had previous inventory. and that's at 41,265. So institutions decided that that was an area where we're gonna break the equilibrium to the opposite side, and thereby creating a supply. So I don't really want to do anything until it kind of gets there. There was a short opportunity when it broke previous day's high, but I wasn't watching that, so we cannot chase. That's a terrible idea. So yeah, bullish. YM is bullish. Michelle says, how do you decide to exit a trade when you don't think it will meet your target? I generally have a sort of a time stop for all of my trades. So if something doesn't happen within the expected range, I have a concept that I refer to as the day trading time zones. And then if we kind of roll over to the next day trading time zone and it's still not there, I will cut it. However, if I'm blatantly seeing something working against me and it just doesn't, like, let's say that I was looking for a short in copper, so I'm gonna use my Topstep X to illustrate that. So I have VWAP here, and let's say we were looking for a mean reversion down to VWAP, but now you see this happening. And let's also say that you entered, like, maybe somewhere. I'm still getting used to drawing tools here, so give me a minute. Where's the rectangle? I'm not used to the drawing tools on Topstep X. Okay, so let's say that you used this candle, red candle, drop below the 9 EMA on a 2-minute chart as your entry, and then you kind of got a decent move down, but then the market pings back and closes another candle above, quite clearly above the 9 EMA. That would be an exit for me, because that's no longer valid. That's not what you want to see. You want to see, you know, if the move is going to continue down, you want to see no initiation, no commitment around the 9 EMAs. So it's the simplest way to exit a trade. You can also have a look at something called the bullish engulfing or bearish engulfing in the opposite direction to your trade and use that. But what the problem is there is that if you have something like a bullish engulfing in the middle here, so you have hammer followed by engulfing candle, you are still below the 9 EMA. So technically that there's nothing to do here. But when it clearly jumps away from the 9 EMA in the opposite direction, that's your early exit. So just like you want to have a clear entry signal, you want to have a clear early exit signal too. I use a mix of time-based versus price-based. But for the most part, I will try to give my trade as much time as possible, because I pick the levels that are generally at some sort of swing extremes of either the day or the range or something similar. So it's not that much of a problem. But if you're entering momentum trades and you don't know when to do an early exit, this could be a pretty decent way to do so. Hoji wants to know, I saw that you're using a 2-minute time frame, not the usual one. What would be the usual one, in your opinion? Because I use 1, 2, 3, 5, 10, 15, 30, and I will flip between them. However, very low time frames for me only serve as timing my entry, not any sort of level. I take my levels from, you know, much bigger time frames, such as, you know, daily chart, value area from the previous session, so that's like the entire session, distribution curve, average ranges and stuff. So I don't really use, like, for example, I wouldn't necessarily use 9 EMA on a 15-minute chart and then use that as a reliable level, because to me it doesn't carry enough information. Like, if that happens to match up with some of my other high probability levels that I take from other concepts, then yeah, I might use it as a confluence, but not on its own. Not on its own. Hope that makes sense. So yeah, 1 minute and 2 minute for me are just timing tools, timing and entry timing tools. The benefit of M2 would be that it's slightly less noisy than M1. So basically 1 minute carries a lot of noise in it, and so does the 2 minute chart, let's be real. But the benefit is if you're trading something that requires high precision, if you're at that point of your journey, it can actually give you an opportunity to front run a trade idea from that sort of a timing entry tool way, rather than waiting for a very large time frame to do its thing. Intraday, very large time frame, I would consider 30 minutes or 1 hour. So it is a very good question, but if you're somebody who's newer to trading, I would probably stick away from very low time frames. 5 minutes is more than enough, and people get caught up even on 5 minutes. So, be very careful. It's not an easy thing to do, and I typically like to teach people on the slower way. So 15-minute chart, orientation level, and then we wait for it to sort of do its thing. And one of the reasons is that the speed of thinking is just not there for some people. So until they develop that, we have to go the slow-mo way. And that means looking at a larger time frame, right? So there's no point getting caught up and misreading 1, 2, and 5 minute charts until you've developed enough discipline to kind of wait for your trade setup to happen. Now, unfortunately, if you have a neutral day type that is fairly range bound, so you don't have a massive range to work with, or maybe even you do, but the whole neutral range day is just chopping in massive 30 to 15-minute candles that have huge wicks and they traverse the entire range of the day. That means that you have to either sit it out until you get better, or obviously if you're more advanced in trading, then perhaps you might want to look at trading from slightly lower time frames to catch those session edges, because that's the trade location for a range bound day. Session edge, session high, session low, trying to snipe it from basically stop runs of those areas. Servant Thought says, if you have a moment, when are those day trading ranges and opening balance for all? Well, for the London session, it's fairly simple because the initial balance is the first hour of trading. So London, its own initial balance is from 8 a.m. till 9 a.m. London time. That will be, I think, 2 to 3 a.m. Central time zones. Bane of my existence. So the first hour of trading for London is always the same for everything. You do have DAX that opens for Eurex, but Eurex is such a tiny exchange that as soon as it happens an hour before London, but it's such a small exchange that as soon as London opens, whatever Eurex has done on most days, it's going to reverse it, right? All right, so let me ask you guys, have you tried the account nicknaming? Did you see all the funny nicknames that we had yesterday from people submitting things? So don't F this one up. That was one guy. So that was pretty funny. Now, if you're, so Servant Thought, if you're referring to the day trading ranges that I use, like the average ranges, that resets for every session and every day. So, yeah, it's a great measure, but for the most part, I'm not going to be able to submit that before the market actually develops a bit. So it's a market. It is somewhat of a market generated information. Like I suppose average daily ranges we can call with some more upfront sort of time. But average session range begins when the exchange opens, and then it tracks it as we're making session lows and session highs until one side is exceeded. So for now, since there was not much change, we are still around the same levels. Obviously, if you're trading the New York session, COMEX, NYMEX, all of the other different products, the opening times will be pegged to the old open outcry exchange time. So if you're trading crude oil, that opens London time 2 p.m. for me, which is 8 a.m. Central, and then gold opens even earlier than that. So it opens 1:30 p.m. my time, which is 7:30 a.m. Central, so pretty early over there. And then obviously we have the cash session, so everybody knows when that opens. And the first hour of trading, the initial balance will always be from the start of the old open outcry hours. Quiet Money World says, can you please explain what you use the 9 EMA for? So timing tool, right? I mentioned this before. Let's drag out this chart. This is the equivolume chart on Ninja. I hear that the equivolume candles or something similar is coming to Topstep X. So I heard it from Rob Cooney. So it's not like some random person, like it's Robert. So we can trust Robert. He knows what's up. And he knows what they're working on on the back end as well. All right, so what I use the EMA for. So let's say that I'm looking for mean reversion, and usually that involves some volatility bands. When I say mean reversion, that could be a failed auction, right? We could have had a move up, tried to get outside of the initial balance, failed. This is where the timing tool can step in to possibly front run that trade even before the auction fails. So what I'm looking for is for the market to have moved significantly away from overnight VWAP, which is my measure. Sometimes I use session VWAP. It's dependent on how far are we away from it. Like if we're in a massive trending day, then I may go to like session VWAP because I want something that is closer, something that I can actually use as a reference point. Whenever you have a level that's too far away and it's like 2-3 ATRs away, that means it's going to take days to get there, so it's not really applicable for the intraday time frame. But if you have something like this, obviously we have the volatility bands, so it goes all the way to touch this second standard deviation, slightly pierces it, but then look what happens. So this is the 9 EMA blue thick line, and this other green thick line is the VWAP. So you will be looking to front run, for example, a failed auction when the equivolume candle closes below this 9 EMA. That's a timing tool. So instead of me waiting for a full 30-minute candle to close, that only becomes a validation point as a part of my continuous sort of observe, orient, decide, act loops, OODA loops, right? That's something that I've used for many years now. And I was so surprised when Anne-Marie mentioned the OODA loops because I was like, that's what I use. And it's front running a trade is a skill and a science and art in many ways, but this kind of somewhat takes out of it takes out the discretionary side to a degree. So you're never like, oh, what is my signal? If you see there was a fake out attempt prior to this smash down, and it never closed below the 9 EMA. So it's like we're still going up. don't touch, nothing. But as soon as volume stepped in to really push us below that 9 EMA, we had some initiation to the downside. Okay. Now this is, I'm looking at the overnight. This is the first one that sort of looks like the one that I wanted to explain. But if we go during the active trading hours, let's put this always on top. Okay, that's better. So let's go back. Again, probably should have looked for some examples of this before I came on. Yeah, so let's have a look. This is an example of VWAP acting as a bounce point, as a springboard, not a bounce point. All right, so here's another one. Now we have to have the price moving at least a couple standard deviations away from VWAP. Otherwise, we're way too close. There's no trade. So that's another thing that it was actually one of the first things that I looked at, like Bollinger Bands and stuff. This was like 16 years ago. But then I moved on very quickly to things like supply and demand and everything. And yeah, so this is a much better way to do things. So second standard deviation. And then the market steps in with some volume and closes the first 1 minute candle below 9 EMA. And that kicks off a very, very nice mean reversion all the way down to VWAP, which then acts as a bit of a bounce point. But ultimately that fails too, and then we start chopping around. So that's the kind of trade that is, for me, is a timing tool. So if I'm looking at a failed auction short, that's the kind of stuff I want to see happening. So hopefully that is clearer. And then likewise, if I'm in a trade and I want to stay in a trade, and let's say we do hit VWAP, but I'm being stubborn, and I'm like, I think this can go further. And then we get this candle that clearly jumps away. That's going to be my exit because it's no longer valid, right? We've turned around. And then you just take your money and run. That would be the early exit. So similar situation, but kind of flipped on its head. Alan says, morning Dee, any ideas on suggestions how to manage a brand new XFA? Most of my XFA accounts start with a drawdown. I'd like to stop that trend. Well, whenever you're in a new XFA, there is always increased pressure, right? But the big issue with people is that they go in hard and heavy with the XFAs immediately, and then without any buffer, anything. So all you have is just that initial maximum drawdown. Like there's nowhere else to go. So until you actually build up a little bit of more of a buffer, at least double what the original buffer was, or the original maximum loss limit, you can't go sizing up. You can't, like, I am somebody who's extremely risk averse for that particular thing. I don't like to, if I've got 4.5K to play with, I'm not going to be going in with 5 lots of anything. I'm going to be starting with like 2 micros, 3 micros, like maybe like 1 mini if I can limit my risk per trade to $170. But I'm usually, the way I like to approach new XFAs is to divide the daily loss limit by 10 for that first part of building your buffer. And then that becomes your personal daily loss limit. So if you only have $3,000 of the daily loss limit, your initial drawdown for an XFA to be successful and to get it off the ground successfully, it cannot go above 300 per day. Because it gives you 15 days or, about a month before you would have to have like 300, losing, and then you would reach the maximum loss limit, right? So giving yourself that time to make mistakes, to readjust your mental acuity and mindset to this new thing. The biggest problem that I see with people blowing up XFAs is that they're so excited to start, right? And that's because of a dopamine rush that happens in your head. You're like, oh my God, I'm funded. Ah, I want to trade. That doesn't work in trading. While the extra dopamine is very good for productivity and motivation, productivity and motivation in traders spells death of the account. So I'm not surprised that that's the outcome for most people who have done that dance like a million times. They get funded, they blow it within days, they get funded, they blow it in days. So to stop that cycle, first you have to be aware of your dopamine levels. Were you excited when you passed the combine? Were you like, yay, I've got a new account, let me trade it? That urge to trade the account is the dopamine rush. It means your dopamine levels are out of whack, and until they level out, you shouldn't be touching any size, right? So 1 micro, just to get used to things. And it's not going to go well. Like the first week of XFA is not going to go well. Expect that. It's completely normal. But at the same time, whilst you're going through that adjustment period, you don't want it to you don't want to dig a massive hole for yourself and then effectively lose it while the dopamine levels are being readjusted. So if there is a faster way to level out your dopamine levels, usually it takes about a month from any sort of dopamine screw up. Anything that you do with your dopamine levels that messes them up, it takes a month to come back to baseline. So keep that in mind. You can fast for 2 days, but please don't do this without, like, if you have something wrong with you, like if you have conditions, health conditions and all of that, don't take my advice for it. But they've done some studies in mice. So it's, again, take with a pinch of salt because it's not in humans, it's in mice, that your dopamine levels level out after a 2-day fast. But, obviously we don't know whether that's true for humans as well. Some people have reported that it has worked for them. But again, we don't know. Let me just 1 second. Sorry about that. Okay. So my dogs are going out. So yeah, they're all excited now. They might be barking. I warn you. Yeah. So the study that was done on dopamine in mice was it showed that it can reset their dopamine baseline within 2 days after 48-hour fast. So. But one easier way to do it is also to do exercise, to meditate, and just to kind of try and chill out and not rush the process, I guess. Everybody wants to rush everything these days, They're sizing up, they're trading like lunatics, and then, blown accounts happen very frequently. So we want to aim for longevity rather than speed, get rich yesterday. So start very slow and expect a drawdown. Make note of your triggers as well. That's a good one to know yourself, what makes you tick, and how you can prevent some stupid things happening in the new XFAs. All right, let's move on. Please check GC. Okay, let's check GC. See, my GC chart here, I'm going to use Topstep. GC is supposed to have rolled to December, and it has. Okay. Yeah, it looks pretty bullish for now. There was a little failed auction. However, 60 point range is not the biggest range. Again, I think everything's really quiet because of FOMC, so I don't think I'm going to be trading today before that happens. So I might just not trade today at all and then pick it up tomorrow, because I want to get the FOMC out of the way. You know, that's generally when people like chop themselves up because they're trading in expectation of momentum moves, which can happen sometimes, you know, when the institutions start repositioning. Like we've seen that yesterday in NQ, but today it's just not. That doesn't look like there's a lot of movement, guys. So be very careful. I do think that they're waiting for FOMC. So I see it across the board, apart from YM. It's in his own little la la land. But yeah, this is not really having much momentum. We've been kind of range bound since about, 4:30. There was a big pop around 4 o'clock my time. And then since then, we've just stayed in a range in gold. So I don't think that gold is moving either. Yeah, so gold on the daily chart, there is some supply here, but it's not. Yeah, it's not that strong. And one thing that I don't like about it is that the prices come back to it really quickly in a very big V-shaped move. That means it's building momentum. So I don't think this supply is going to hold. It's also continuing to create those higher highs. That is a sign of an uptrend, and also higher lows. So for now, I would say demands are in force, and I would be looking for longs. But obviously, let's see what happens with the FOMC. For now, this is all very quiet for my liking, and I ain't getting involved in these sort of moves. So yeah, gold, also nothing there. So let's focus on the questions today, because, obviously FOMC tends to be super quiet. Do you ever use open interest call wall? I do not. I know that a lot of people who trade equities, they use that, but I'm not a core equities trader, and those sorts of things are just not, they're not necessarily relevant to the products that I'm doing, because they tend to be connected to geopolitical risks and driven quite a lot by the physical underlying supply and demand of the physical products like gold, crude oil. So it's a slightly different way of looking at things, and because of that you can pinpoint some pretty good areas where interest was done before, just looking at where the price has turned, because that's usually where the institutions had some interest, and then that's what you look at. It's not like some hidden level that you have to look through open interest. So I don't use that, but I do use the volatility bands, which do have the options and open interest. Sorry, not the volatility bands, the volatility indices, indexes, however you call them, to sift out whether we are in a day traders market or not. So for example, CME has these volatility indexes. And the volatility index will have a degree of like options and open interests calculated inside them. So that's as close as I come to that analysis. I, again, try to keep things simple. I know that for some people, you see like several different components of what I do, and you're like, oh, that's really complex. It's actually not. It's actually really complementary to price action, profile, supply and demand, and average ranges. So to me, it's a very logical way to do things, but I don't go out of my way to look at, options, 0 DTE, this, that, and then the other. I don't get lost in a barrage of analysis paralysis sort of moment. I know what works for me. I have backtested my levels to death over the last 11 years. And yeah, just keep it simple. I mean, we always say that, don't we? But it's true. Like if you start to look at everything that everybody else is looking at, you're gonna get lost. So if you have something that is even partially working right now, don't throw out the baby with the bathwater. Don't discard that. Take it, mold it, add stuff to it, see what works for you, see what doesn't work for you. Keep the stuff that works, throw away the stuff that doesn't. It's the only way to do things. That's why we have trading plans. Trading plans are not there to go, oh, today I was wrong and my plan was completely off. I was a muppet. That's not really a plan. Like what you want to be doing is to track what's worked, what's not worked. So for example, yesterday when Mark's talking with Dee, Robert noticed that I had some stuff that I was writing down in the journal, and he's like, well, what is it? I want to see what you write in your journal. And this is what I wrote, very technical. Stop run into Asia low at 11:19 a.m. Previous development, open below value inside range. Reversal during initial bounce from value low. Attempted value acceptance. Resulted in a sustained auction short to double bottom Asia. So, there's nothing like, didn't work, this didn't work. It's literally just an observation of what actually happened and what sort of open sentiment we had. That's all I need to know, right? Because next time, when I have the open below value inside range, when I have the bounce from value low, but also Asia low further down, I want to look for a stop run around sort of 11 a.m., 11:30, half an hour range, and see whether that is maybe something that happens quite often. That's how you create a strategy. You find something, you observe something that happens, and then you try and make that work for you. You try to make it repeatable. So for me, that's how I journal these days. Now, if you go back 10, 11 years, my journaling would be similar, but it would also have an emotional component to it. It's like I entered a trade, it was too early, felt like crap. But then that's me tracking my emotional triggers. So, these days I can stay pretty cool-headed. Like, I don't know, just losses, they don't really bother me these days as much. So I suppose it comes with time and just realizing that as long as you control your risk, that positive expectancy shows up over time at some point. Like, you just have to wait it out, be disciplined, and that's the tough part for a lot of people, I guess. Right. If Ivan says, if IB has a very wide range, do you still wait for the price to do a failed auction or just fade it near the high or low? Oh no, I would still wait to do a failed auction. In fact, the bigger the initial balance and the closer you are to one side of it, the higher the chance that you're going to have a partial failed auction. Now, it's not going to be a big failed auction on like 99% of the time. Why? Because usually large IB is caused by some sort of a release. Typically CPI, PPI, something that kind of starts with something that happens around the COMEX Open, right? Or Globex Open as well. So because of that, you get these massive initial balances in typically gold. And then what I typically do is either look for partial failed auction and then look for another range to be established on slightly lower time frames post-release, which I will then use as sort of like a Dolby strategy to bounce off of that. And typically trying to maybe take the trend that happened for the release and then maybe even use VWAP from that release because it's a session VWAP at that point. So that can be something helpful. And in fact, I like when I see the big initial balance because it means the day is generally a lot easier to read, at least for me. Undauntable says, with copper's initial balance so tight, would you consider the downside and upside failed auction or nothing burger? Absolutely right. Yeah. So this is just a range. This is neither a failed auction nor anything. This is just the market pinging back and forth in about a 60 tick range. It's too small because it means that the most absolute most profit in the perfect world is to wait for the absolute low of the session, absolute high of the session, and then to just try and snipe like maybe 20 to 30 ticks, maybe. And even that is going to be tough. So not a lot of opportunity, not a lot of stuff to do here. Even when I scalp, I don't scalp 10, 15 ticks. I'm not that kind of a trader. I like my scalps to have about 30 to 50 ticks in them. Ideally 45, 50, right? That's like worth my time. Anything else is just me losing my eyes, getting myself stressed out, and potentially even losing money, because neutral days, one side can have a greater pull, and then you do one good trade and then the second one smacks you in the face, and then you have to wait for a really long time to get the other side, trying to stay away from the middles. It's not easy. Range trading requires patience, timing, and accuracy. It's, it will be one of those things where you're so annoyed. If you're somebody who gets annoyed with like a traffic jam or waiting in queues or something, range trading is probably going to be quite difficult for you, because you can stay in range bound trades for a couple of hours. 30 minutes for sure, but a couple of hours is I've seen range bound trades with a decent range that just take forever to go back to the mean. Hey, Nick for a Tick is in the chat, saying hi with my coffee. Hi, Nick. Great to see you. You getting ready for the baby? Practicing. I'm actually setting things up so that I can get people in. I just want to get like a little bit more used to me running these in the morning. But yeah, so I'm really looking forward to having guests on. Obviously, Jay was in the chat yesterday. Dakota said that he might wake up early one day, and we have Nick for a Tick here as well. So yeah, so once I get my head around it, I am setting everything up so that I can get you guys in here. I'm gonna run a test this Friday, and then maybe next week we can have some guests to make this London session more dynamic. So Nick, are you trading or are you just observing? Let's have a look at some other questions. When does the trading in GC normally start in USA? 1:30 London time. Yes, so it used to start in like 1:20 p.m. because that was the old open outcry pit start time. But because it's kind of like a lot of the platform at the time couldn't really start the calculations of indicators and everything, and they couldn't start the candle on 20 minutes past. And I think that's probably still the case in a lot of the platforms. So what's happened a few years ago, everybody kind of agreed that Globex and Comex should start at the same time. And now we have Comex 1:30, Globex 1:30, party begins. Now cutoff time, that's up for discussion, because some people are purists, so they take the settlement time in gold, which is 6:30 p.m. my time. Copper actually closes half an hour earlier, so 6 p.m. London time, copper ends. Even though there's still some movement after that, the volume will be very muted. Crude oil closes at 7:30 p.m. But I like to keep my profiles open until the end of the electronic close, into the electronic close even, because I want to see what happens in that after market too, because sometimes we can actually have some really good movement. So I just keep it to the entire electronic session. Tonya, so no, not really. So my strategy is supply demand, not really support resistance. Support resistance if we're in a neutral day type. And even then, session highs, session lows, they don't necessarily have to be obvious support and resistances. It's just that's where the market makers decided to turn it around. And sometimes it's like completely in the middle of nowhere. You had like a trending day and then they suddenly start chopping around. And, is that true support, true resistance? You really need to have a movement away from an area to call it support and resistance. So I would kind of argue that that's not the same thing. It's more like a range that we currently have, right? So highs, lows, for me, like the way I define support resistance is when you have, like, let's say, a move from clear low that goes into a trending move. Then again, another one, let's find one to the downside. Here's another one. So I would think this is support that goes into a clear down move. But when you're chopping inside a consolidating range, I suppose you can call it support resistance on a very low time frames, but I kind of look at those two things those concepts as two different things. Consolidating range, highs and lows, versus support resistance, and then also versus supply and demand, because supply and demand actually has like 6 different things that you need to look at in order to qualify an area as a good area for a bounce. So it's not just having a move away. They look at how did we leave the level? Did we arrive at the level with clean sort of drops or a clean rise, or was it pretty choppy and thereby creating opposing areas? So all of that will lower the score of the zone. So that's like supply and demand is something that I usually look for larger time frames, and then I use market profile for the day time frame, open sentiment, and deciding whether the auction is doing well or not. And then I have the average ranges, right? So those things are my core method. Anything that I talk about on the 1 minute, 9 EMA VWAP, that's just timing tools. That's something that's been around for, I don't know, however long, man. Like since I started trading in like 2008, that was actually the first thing that popped up. So I don't feel like that's something that I need to teach people, because it's like, doesn't everybody know that? I could be wrong. I could be, so long in this industry that I've kind of lost perspective of what people know, what people don't know. But, timing tools, 9 EMA, and then mean reversions down to VWAP via second standard deviations. Those are some of the things that were on baby pips back in the day. So I don't know whether they still have that for free. And that's what I was looking at. What time frame do you scalp? So I don't really like to scalp. And if I do scalp, usually that's going to be ES for the last sort of half an hour of the day, if I'm going to scalp. But for the most part, I'm not a scalper. We can get a scalper on here. Nick Furtek is a scalper. He stays in his trades. Like, he looks at bookmap, he has his levels of reference, and then he just goes in and out. My trades, even when I'm scalping, they probably last like 5 to 10 minutes. So, is that scalping? Probably not. And, I'm not a high frequency trader either. I trade. Like, my idea of overtrading is if I've done like 13 trades for 12 hours. It's like, wow, that was terrible. Do you use a percentage of a dollar amount to determine a max loss exit point, or do you use indicators breakover? I generally use risk reward based on whatever I'm risking, and then whatever risk reward I can get out of it. Anything 2R multiples and over is wonderful, but I do use 2R as my default risk reward. And typically that doesn't really have much to do with indicators or opposing levels unless they're in the way to my 2R target. Then I will be like, maybe I should cut this early. But generally I try to get involved in trades that don't have anything sort of in between my target. Just got a message from Jay. That's great call on those ES levels. Yeah, that was a good one. Okay, let's have a look at some more questions. Nick says, I'm still holding some short dated calls bought on the lows yesterday. Okay, was playing for a pop from Microsoft to FMC, basically this exact move. Nice one. Do institutions trade futures at this time? London institutions, absolutely. And I'm pretty sure they have overnight positions in the US. You have overnight clerks that, even over here we have like clerks that work during the Asia session. But, the institutional trading is not this. You're not trying to outperform the market. They generally have very different goals that are based on some strategies. And when you have a clerk who's just filling orders, they're not making a decision. They're just like what MP calls it, executors, right? You have a level and the strategist will tell you, okay, we have this client, fill 3,000 orders at such and such a price. And then the clerk will be the one filling in those orders in sort of a zone. That can take weeks because those sorts of orders are like massive and you just can't fill them, especially not if it's a thinner market. So very, very different style of trading. This is why when I say, or when you hear Hogue and myself say initiative activity, other time frame participants, that I don't know why I always try and do a Hogue impression when I say that. Other time frame participants. So when we say that, that means that's the institutional footprint, right? So we're looking for the institutions to make their mark, to make their move, to move out of the market maker territory, which is the initial balance. And then depending on how successful or unsuccessful that move is, we can then determine whether we have a potential for a trending move or whether we are staring at a failed auction. That's why so much volume comes in, because the institutional players try to step in, and it just fails. They're not able to break through a level. There's not enough inventory to take them higher. And then all of that, those positions get smacked on the face and we get huge volume in the opposite direction. That's how you get failed auctions. So anytime you see volume that could kind of like tries to break out and it doesn't have power behind it, it's going to be a fake out. It's going to be a fake out. And that goes for anything that you're looking at. You can be looking at VWAP. You can be looking at 9 EMA. You can be looking at any level. If you don't have initiation and commitment in volume behind the move, you're not going to get the move that you're looking for. So just keep that in mind. Jules Tugara says, dumb question, what is this auction you all speak of? Well, this is the auction process. Remember how the markets started, or maybe if you don't know how the market started, they started with very simple auctions. Futures began because traders that had like actual products, like farmers and stuff, they like agricultural produce, they needed to either offload extras or to hedge against maybe some unfavorable seasonal conditions that are happening, or maybe they're expecting them to happen. So futures kind of came out with a way to hedge your physical produce, and that was the auction. So you go to market, you go to the auction, and that's how it all began, right? Now we have this, which looks nothing like the auction. But everything that you see on our charts is the two-sided auction process. So look into auction theory, look into things like distribution curves, look into Jim Dalton's books. That's where I started, even though I took on the original ideas and I moved them on to kind of improve them, maybe define some things further that I was seeing in the market that I can, take advantage of. It has been completely transformative for my own intraday trading, and I'm able to find some, really good positions that I can hold for a couple of hours and get like 150 ticks out of it rather than 5 and 10. And that's something that suits my personality because I'm somebody who has a lot of patience. I can sit on trades forever. And, I think I do stupid things when I try to scalp. So it's just not, if I'm not taking the majority of the move that's happening, I'm not happy. So there's like a weird perfectionist thing happening that I've never able to get away from. And I molded my trading style to suit that. The older I got, the less grasshoppery I got, because I call over trading grasshoppering when you're in, out, like you have one level of reference and you're like short, long, short. And I see a lot of people who think that's what scalping is, but watch Nick for a tick. Watch him how he trades. He doesn't do 1 million trades per day, right? He finds that one high probability opportunity, pounces, and then he's out. But Dee, if I was to do that, I would be like, I saw that opportunity, but I only took a little bit out of it. How can I get more? And then I start doing stupid things. So it's not for me. It's just not something I do. And I know Eddie Horn, he's a great scalper too. So just some people are okay with taking the small chunk of the market, being happy, sizing up, that's it. I like to size down and get a bigger chunk of the market. So it's a completely different way of doing things. But it's a way that suits me better. So, there's like 1 million ways you can make money in the markets. But you do have to find a style that will suit what you're all about. All right, so let's take one last question and then we're going to finishing up. Is trading a zero-sum game, meaning for every winner there is a loser? Technically, yes, it is a zero-sum game because for every order you have to find the opposite order. But there is such a time when the frequency of orders that are coming in is kind of coming in faster than the other side, therefore building volume to that one side, making it into an asymmetrical move. Does that make sense? So it's not that, we have, more buyers than sellers. Yes, but even they have to pick up their orders from somebody. So hopefully that makes sense. It is a zero-sum game, but there is a kind of velocity of price and volume coming in that creates the asymmetry in the auction market, in the markets in general. What program am I using now? This is my charting platform. I use AMP Futures MT5, and my indicators are on here. So I have Blatek Supply Demand, Blatek Market Profile, which is this panel here. As a part of that, you also have the volume profile, which is here. I like to hold the volume profile on very large time frames. And I have the Blatek DR. Those are my 3 flagship indicators that I usually have on my chart. Full disclosure, it is my company, so I'm just the managing director, so we do have a CTO, we have an executive director, but we do have a software development company that creates and sells these. So you can check them out on blatek.co.uk, or just go on my website beneath every single video, even on my YouTube. If you go to my YouTube, I think the links are below this video. Below every video, there will be links to Blatek, so if you want to check that out, that's great. I love AMP Futures. AMP Futures, I've been with them for quite a while now, and it's something I'm used to, and I think we've done a fairly good job. We're trying to get some of the flagship indicators into NinjaTrader as well, but it's taking time. Obviously, these indicators have some functionalities like the backtest mode directly on the chart. Literally just goes through all the sessions and all the volumes and everything. This is something that I wanted. So it doesn't erase candles, but you can see exactly how the levels were being built and what the day looked like. So very useful. All right, that is it for today. No trades, guys. It is FOMC, so let's wait and see what happens later. Until then, thank you for all of your great questions. It's been very enjoyable, so let's keep this going for tomorrow as well, where we might be able to find some better opportunities. I will be on Fast Markets today with Nick for a tick, so I will see you guys a little bit later today. Take care.